So you're making $100,000 a year and you're still wondering, can I actually buy a home in the GTA right now? You're not alone. This is a thought that a lot of people that are making $100,000 are actually thinking right now. There's high prices, the interest rates are higher, the stress test, it can be brutal for a lot of us here. And it's leaving a lot of would-be buyers thinking, can I actually get into the market? What does $100,000 actually get me right now in 2025? So in the video, what we're going to do is we're going to talk about that. I'm going to go a little bit deep here with the numbers, bring it down to a real situation here, show you what that looks like comparing minimum 20% down payment, factoring in today's rates, and showing you what the actual monthly payments might look like. So if you're thinking about doing this move or considering it down the road, at least you have an idea of what your monthly expenses are going to look like. So we're going to talk about what also kills affordability the fastest, what smart buyers are actually doing to make it work right now. So stick around to the end because I'm going to show you how to stretch your income a little bit further and actually make home ownership work even in this market today. So here's what we're working with today. We got a $100,000 household income. You could be a single or you can be a dual household income. $100,000 total. 25-year amortization is what we are going to deal with. We're going to do insured, which is under 20% down, and we're also going to talk about uninsured, which is 20% down and more. 2025 rates right now, we're going to talk about 4.1 fixed insured versus a 4.4 fixed uninsured rate. Those are the baselines we're going to use. This is just an opinion video. If you need actual rates for the day you're watching this, reach out to us. We'll get you the exact numbers that make sense and give you that scenario for today, because you might be watching this years from now. We don't know where you're at. Lenders right now, they're going to cap your household budget at about 39% of gross income, which gives you about $3,250 a month to spend on your actual housing costs. Now that's everything: mortgage, taxes, heating, condo fees. We're going to apply the stress test here, meaning you have to qualify 2% higher, roughly 6 to 7% right now, even if your actual rate is lower. And for this video, we're looking at resale homes only. We're not talking pre-construction. So we're going to get into the numbers right now. We got a 1-bedroom, 1-bathroom condo at City Place in Toronto, downtown area, listed for $520,000. What does that look like space-wise? Well, it's got 535 square feet, built in 2008. It's got good amenities like your gym and a pool. Condo fees here, roughly $428 a month. Property tax is about $300 a month. If you went the 5% route here, we're talking a mortgage that ends up being $513,000, and your payments are going to be about $2,740 at this number. All in with your fees and taxes, you're talking about $3,468. Does not include your heating costs and things like that, your internet. Keep that in mind. 20% down situation on this one, mortgage, $416,000, much more realistic, thinking about paying that off over a 25-year term. Now, 4.4% number monthly is going to look like $2,290. All in, all encompassing without those utilities is going to be $3,018. The verdict here is with 5% down, you are at the ceiling. With 20% down, it's actually manageable. This is the common entry point for most solo buyers if you're making about $100,000. And I got a bonus insight for you here. The condo, it likely passes the stress test in both scenarios, but your debt and credit, they need to be tip-top shape for that to happen. And the condo fees here, they're moderate. Anything higher than this is going to push you kind of to the limits of your approval. So if you're looking and maybe this is not the building and the price and the fees, keep in mind, as these fees move, so does the option of it actually making a check for your mortgage approval here. Next option we're going to talk about is a Brampton freehold townhouse. $650K is what we're going to call that pricing here. And this is at 35 Doris Court. Now, 3 bedrooms, 2 bathrooms. There's no condo fees here. It's an older building. Taxes, you're talking about $600 a month. So not all that different than paying $300 for property taxes and paying $400 for your maintenance fee. Mortgage here, if you did the 5% down, it ends up being more like 6% once you encompass everything. That puts you to $3,380 a month, all in $4,030. So definitely more money, but you're going to get more house. The verdict here is you're actually not going to qualify. The payment is too high if you are doing the 5% down or 6% rather, and you're going to fail the stress test. If you do the 20% scenario, you're going to have a $520,000 mortgage, you're going to have a $2,858 payment, and then your total payment encompassing taxes and everything is going to bring in about $3,500 a month. The verdict on this one is it's barely going to work. It's going to work though. Your lender's going to look at it closely, examine all the other debts, and if everything else is clean, no car loans, no student loans, it is possible here. Now this is where a cosigner might really come in handy. If you have a parent or somebody that can sign on title with you, it might make a huge difference for you in terms of getting past the stress test bump. Now, if you're buying a loan, even with 20% down, this might feel pretty tight for you. You might want to consider if this actually makes sense as the right move for you, or if you want to take a downgrade and maybe get a 1-bedroom condo instead. The third option we're going to talk about here, it's a stacked condo townhouse in the Applewood community in Mississauga. We're going to pull one from Forestwood Drive. Now, this one here, we're going to use it as a list price of $620,000, 1,100 square feet, condo fees $731, property tax $400 a month. Property tax, as you can see, is much higher in Brampton. Now, 5% down scenario, $606,000 mortgage. Your payments here is going to be about $3,200. All in, you're at $4,300 to $4,400 a month, give or take. And the verdict is this is not going to work. Even if the lender approves you, this is going to be something you're going to be way too financially uncomfortable with, hopefully, especially after watching this video, to want to make the payments on something like this. Now, sometimes the lender is going to give you an approval number. Doesn't mean you have to go and spend that much money. You should really consider what makes you feel comfortable, how much you actually want to spend, not how much the lender is actually going to approve you for. Now, the payment here, all in, you can be up to almost $4,000, so $3,860 roughly if you go with the 20% down situation. Still, $4,000 versus about $43,000 to $44,000, still a big amount of money to spend monthly on a stacked condo townhouse in Mississauga. The verdict here, obviously, is still very tight. The higher condo fees of $700 are killing your borrowing power. And if the same unit did have a smaller fee, maybe $400 a month, let's say, you would qualify more than likely. Now, the takeaway in this specific situation is consider these maintenance fees. When you're looking at properties, really consider what are these maintenance fees going to be and what do they cover? Maybe you can get something that has $200 or $300 less maintenance fee, but the pricing is higher, but your net monthly is actually going to be lower. So what's really killing affordability in a lot of these cases? There's top 5. I've got 5 killers of affordability for you right now. Condo fees. The lenders, they only count half of these condo fees, but you're paying 100% at the end of the day. The property taxes, places like Brampton, Durham, you're going to pay more than $300 a month in a lot of cases, which is just a lot to swallow. The third thing, the stress test. You're qualifying 2% higher than what the posted rates are right now. So you always have to consider that's going to kill your buying power, but it's also going to mitigate you overpaying and being strapped financially month to month. Your existing debt is the fourth thing to consider. If you have car loans, student loans, all of it, it's going to reduce your borrowing limit, but it's also going to make you feel a lot more tight, probably in the chest, by having these massive monthly payments. And your credit score is the final thing here. Lower credit score, worse rate, smaller mortgage approval. If you have good credit, you're going to be in a much better position. If you have $100,000, you need to adjust to reality and what you can actually afford right now. Not wishful thinking that it's a detached home or a townhouse all the time. You need to actually look at the market and see what you can afford based on what you make. Now, smart buyers right now in 2025, they are doing a few things. They're getting pre-approved first. Know your max before start browsing realtor.ca or any of the other websites. They're exploring some of the fringe areas, maybe Etobicoke North, they're going, South Brampton, some of the areas that maybe aren't going to be as popular, but you're going to see your dollar go a little bit further. They're also partnering up with cosigners or co-buyers to unlock more affordability. You got a really good friend that maybe wants to get a house as well. You're considering renting together. Maybe go the buying route. There are some restrictions there. You might want to see a lawyer and see the options first, or maybe it's a family member. That might make more sense to do that co-buying scenario with. Buyers that are smart right now, they're negotiating on older listings. They're not worried about it being fancy and new. They're finding something that's sitting for a little bit longer in terms of the days on the market, 30 plus days, and then they're negotiating on these opportunities. And the older the house, the more work it needs. It's going to potentially give you more buying power. Now, they're also cutting debts before they're applying. So if you have a $300 a month payment, that's going to maybe lead to about $60K less in approval. So maybe you kill that car payment altogether, whether you get rid of that car and just get a used vehicle, no payments, or you pay off that vehicle. That is going to give you a little bit more affordability when it comes to getting that pre-approval process done. And these buyers are prioritizing lower property fees. So aim for 300 to 500 maintenance max. Finally, they're checking the first-time homebuyer incentive programs that are out there. The RSP rebates, they're going to help stretch your budget a little bit more. If you have money in your RSP, pull that out for your first-time home buyer. It's going to be something that you get one opportunity to do, so you might as well consider pulling that out. Consider smaller markets if you want to see your money go further for you to get you more house. So a Hamilton, an Oshawa, a Guelph. These are going to give you more options at 100K. You may not want to leave the GTA, but if you want more house, that might be something you have to weigh those two options with. So what can 100K get you in the GTA? Ultimately, right now, it can get you a one-bedroom condo in Toronto with some flexibility. A townhouse in Brampton, if you have enough down payment, if you have a skinny down payment, it's not going to work for you. A condo townhouse in Mississauga, only if the fees are low. The key isn't just finding the right property right now, it's knowing the full cost picture, understanding what your limits personally are for each house that you're looking at. The bank might approve you, doesn't mean that it's affordable at all. Run the math, look at the numbers, break everything down on what you spend each month, because these are your household expenses we're talking about, but you might have 2 or 3 TV subscriptions. You might get coffee out every single day. All this stuff adds up, and it's all money that you need to have at the end of every single month. If you want to break things down a little bit further for yourself, you can always click the link in the description, book a one-on-one call with me, figuring out what makes sense for you. You can always text me, number here on screen if that's easier for you. And ultimately, end of the day, owning a home in the GTA on a 100K salary, it's pretty hard. But with the right plan, it's absolutely something that's doable. Thanks for watching this video. I'll see you in the next one. Bye for now.